Welcome to this explainer. If you've spent any time in the crypto markets, you know exactly how wild it gets. The sheer speed, the constant volatility, and let's be honest, the emotional roller coaster of trading. It's enough to make even the most seasoned investor deeply skeptical. But today, we are taking a high-tech deep dive into an automated system designed to completely strip human emotion out of the equation. We're going to look under the hood of this fully automated 2x margin trading setup called CryptoBot to see exactly how it manages risk, hunts for opportunities, and executes trades based purely on hard data.
The entire philosophy here is built around a 24/7 emotionless trading ecosystem. Now, I know what you might be thinking. You hear automatic crypto trading on 2x margin, and your first thought is probably, isn't that just a fast track to losing my shirt? And honestly, that is a totally valid fear. Leverage amplifies your gains, absolutely, but it also doubles your losses. A 50% drop in price, that could literally wipe out your entire position. But that is exactly why this system was built. It doesn't rely on gut feelings, late-night panic selling, or whatever hype is trending on social media. It relies purely on algorithmic execution and technical analysis. It's just scanning the markets day and night, calculating probabilities, and executing trades while you sleep.
So here is our flight plan for today. First, we'll look at the long and short pots. Second, the four-step pipeline. Third, the market thermostat. Fourth, the protective shields. And finally, margin health.
All right, Section 1, the long and short bots, hunting opportunities.
So how does this thing actually pull a profit no matter what the market is doing? Well, it's a two-pronged attack. On one side, we have the long bot. It's constantly hunting for moments when the market is oversold, meaning the RSI or relative strength index is super low. It waits for the sellers to totally exhaust themselves, buys in at the bottom, and then profits as the price climbs back up. For example, if Bitcoin takes a dive to $90,000, it buys. When it rebounds to $92,000, it sells for a nice little gain. Then, on the flip side, we have the short bot, which does the exact opposite. It looks for that overbought euphoria when the RSI is peaking. So if Ethereum is struggling to break past $3,500 and starts showing weakness, the bot borrows and sells it, aiming to buy it back cheaper, say around $3,400, securing a profit from the drop.
Moving right along, Section 2, the four-step pipeline, execution logic.
You might be wondering how the bot actually decides to pull the trigger. It's definitely not just throwing darts at a chart. It actually runs every potential trade through a really strict 4-step software obstacle course. Step 1 is the analyzer. This thing scans up to 200 crypto pairs every 3 seconds on a massive 4-hour time frame to spot big picture opportunities. But crucially, it doesn't buy yet. It passes that signal to Step 2, the watcher. Think of the watcher like a patient sniper. It zooms way in to a fast 5-minute chart, just waiting for the exact momentum shift, like a healthy little pullback, before it gives the green light. Then, Step 3 is the executor. It runs through strict safety checks, making sure you haven't hit your maximum allowed positions before officially placing that 2x leveraged order on the Kraken exchange. And finally, Step 4 is the closer, which takes complete control of the live trade to ruthlessly manage the exit.
Section 3, the market thermostat, the macro filter.
Look, even the smartest bots in the world will get absolutely wrecked if they try to trade against massive macroeconomic shifts. So how does this system survive a sudden, brutal market crash? It uses a 0 to 100 market regime score. Think of it as a weather thermostat that the bot checks every 5 minutes. It's a weighted average calculated using some major factors, primarily where Bitcoin's price is compared to its 50-day average and the overall market breadth. By market breadth, we mean out of the top 100 cryptos, how many are actually going up? This score smooths out all that chaotic daily noise and tells the bot the true big-picture direction the wind is blowing.
And here's how that score is actually used in practice. The golden rule here is simple. Never fight the current. If the score is under 45, we are in a bear market. The system physically blocks all long buy orders. It flat out refuses to catch a falling knife. If the score is over 55, we're in a bull market, and it completely blocks all short sell orders. Between 45 and 55, the market is in neutral territory, so both strategies are allowed to run. This one simple filter prevents the absolute most common trading mistake, which is betting against the dominant trend.
Section 4, Protective Shields, Capital Security.
Okay, so you've got perfect timing and macro filters, but trading on 2x margin is still inherently risky once your money is actually out there on the market. What protects your capital then? That closer module we talked about earlier deploys some incredibly strict defensive shields, starting with break-even protection. The exact moment your live trade hits a 2% profit, the system instantly triggers this shield. It completely cancels your original loss limit and drops a new hard stop loss at plus 1.5% above your entry price.
Why exactly 1.5%? Because that perfectly covers the exchange fees while leaving a little buffer. Once this shield is armed, you are mathematically guaranteed to walk away with a profit. The trade becomes completely risk-free from that second onward.
And then we have the second shield, which is the trailing stop. Let's trace how this works. You enter a trade. At a 2% gain, your break-even protection arms. Now, as the price keeps pumping, let's say up to a 6% gain, the trailing stop activates. Think of this like a mechanical ratchet. As the crypto price climbs, the stop loss climbs right up behind it, continuously locking in your profits. But, and this is absolutely crucial, if the price suddenly reverses and crashes, the stop loss never moves down. It stays exactly where it was last anchored, immediately cutting the trade and securing the maximum possible profit before that crash ever hits your wallet.
Finally, Section 5, Margin Health, Avoiding Liquidation.
Let's tackle the ultimate doomsday scenario every investor fears when dealing with leverage. How do I make absolutely sure the exchange doesn't liquidate my entire account if everything goes horribly wrong? CryptoBot answers this by giving you total transparency through a real-time dashboard. To avoid liquidation, you just need to understand 4 numbers. Your capital, which is your actual hard cash, your USD available, which is the cash free to use for new trades, your total positions representing the leverage value of your active trades, and most importantly, your maintenance margin, which is the absolute minimum cash the exchange requires you to hold to keep your positions open.
To make all of this math completely effortless, the dashboard boils everything down into a simple, color-coded margin health percentage. If your health is above 150%, you're in the green. You are completely safe, and the bot handles everything for you. If it dips between 120 and 150%, you're in the yellow alert zone. This means the bot is heavily loaded, so you'll want to keep an eye on things. But if it drops below 120%, you are in the red danger zone. The beauty here is that you have clear, actionable data telling you to intervene long before a liquidation event ever actually happens. You can step in by manually closing a losing trade to free up margin, or simply by adding more capital. You are never, ever flying blind.
To wrap up this explainer, I really want to leave you with a core piece of philosophy baked right into this system's architecture. The bot doesn't fight the weather, it trades with it. By combining that big-picture macro trend analysis with ruthless, emotionless risk management, systems like this represent a massive shift in how we navigate the markets. And it really begs a fascinating question for us to ponder today. As these data-driven algorithms become increasingly sophisticated at protecting capital and locking in gains, are they destined to completely replace human trading intuition altogether? Thanks for joining me on this deep dive, and keep learning.